Now, that is the double calendar. I'm going to show you how to enter into a position of the sale of an iron condor. And it's basically a very similar position. However, it's a little trickier to manage because of the fact that both of the options that the option that you're selling and the option that you're buying is in the exact same month. They're both in the front month. And the reason that we do not do this trade with less than 30 to 40 days to expiration is because normally you can't find trades that are priced right. In other words, if you want to go far out of the money on these trades, you're not going to be able to sell much of a premium on them. And that's the way we want a very large profit range on these trades. And let me show you exactly what I mean here. On this EEM, you can see that we only have 23 days left to expiration. So this is not the optimal time to enter into an iron condor, and let me show you why. If we wanted to have as wide as possible profit potential, we'd want to go at least $15 above the current strike price, which would be the 165 strike price on the EEM, and if we were to sell that option, we'd only receive about 10 cents for it. Because remember, you're selling it at the bid. Well, the bid is only 9 cents in this case. Maybe we could squeeze another penny out of this particular option and get 10 cents for it. And our protection, our protection is going to be much cheaper. It's only 5 cents. But that only leaves us with about 4 cents of profit potential. That's not very much. But let's take a look at it just for an example purposes. We'll take the 160s. We'll right click on those. And now you can buy an iron condor and you can also sell an iron condor. If you buy an iron condor, that means you're buying a position in which time decay is working against you. So you always want to sell an iron condor. And all we have to do is come down to iron condor. We go to sell iron condor, and that brings up our dialog box at our call strike price of 160. If we're to sell the 160, we're going to buy the 165 for protection. And remember, we're running a business here. So what we want to do is we want to sell for more than we buy. And that's exactly what we're doing. We're selling the 160 calls for 38 cents. We're buying the 165 calls for 15 cents. The difference is our profit. Now on the put side, we want to go at least, in this case, we're going 10 points above the current price. So we want to go 10 points below the current price. The current price is 146.79, so we want to try to hit 135 if possible. Now on the downside, we actually have a little bit better premium. The 135 is selling for $1.16. So let's put in our prices here. We go to the 135 put. Now we want to sell for more than we buy. And that's what all good businesses do. They sell for more than they buy their product for, right? So we want to go down to the 130s. Which is a lower price than our 135s, and the difference between what we buy and what we sell is our profit, just like any other business. So it looks like we can get a 81-cent credit on one contract. Now, how much is that actually going to give us in profit? Well, if we bring up our dialog box, it does calculate, because we are in the same month of buying. We're in the same month for both the sale and the purchase of our options. It can give us the maximum profit, maximum loss on this position. Our maximum profit is only $81 on one contract. Well, you can say, well, that's not very much money, but we only have to put up $400 to earn that $81. And that's close to that's a pretty good return on your investment. That's about 20% return on your investment in just a couple of weeks here before the expiration of these options. So that's not too bad. Let's take a look and see what happens if we do more than one option. Let's say we do 5 options. Well, now we're earning $400 on $2,000 of money that we have to put up in margin. That's still, a 20% return on your investment in just a couple of weeks. That's not bad. Let's take a look exactly what this position would look like on our profit picture. We're going to right-click on this red area, and we're going to go to Analyze Duplicate Trade. Now we already have the other simulated trade in here. We're just going to X that out, close that out, and then we're going to take a look and see exactly what this looks like on our profit picture. Even with only 23 days to expiration, we have a fairly wide break-even on this position. Our break-even, and we can set these by going to Set Slices, and we're going to go to break even on the date of our option expiration, which is May 17th. We can see that we have a fairly wide profit potential in break-even points at 134.24 on the downside and 160 on the upside. That's not too bad. The price can move close to 12 points on the downside and about 13 points on the upside. We're right in the center of that, and that's exactly how we make our money. As long as the price remains in this profit area, oops, I just widened that out too much. As long as our price remains, our price is right now in the center of our iron condor, and that's where we like it to be, because the closer we get to expiration, then the closer we'll get to this green line, which is the maximum profit potential we will realize at the expiration of these options. The nice thing about iron condors is if you do take it all the way to expiration, you have no cost to close out these trades. You're not paying another commission to sell them out. The problem is, of course, is once this price, however, gets to one side, then we probably will have to do an adjustment. Most people will simply put on an iron condor like this, and they think, if it moves against them, they're just going to close it out at either a small loss or a very small profit, probably at a small loss, and they say, well, iron condors don't work, because they don't know the art of adjustment. The adjustments are everything. You don't just put these positions on and let them run against you without making some sort of adjustment. And that's where the real science of trading as a business comes in.